Welcome to Business with Louis, the show where we explore the latest trends, strategies, and insights in the world of entrepreneurship and business. Warren Buffett is widely considered one of the greatest investors of all time, with a net worth of over $100 billion. His investment strategy has been studied by business leaders, entrepreneurs, and investors around the world. So, what makes his strategy so unique? At its core, Warren Buffett's strategy is about long-term value investing. It's an approach that focuses on buying high-quality companies at a reasonable price and holding them for the long haul. This means doing thorough research, analyzing financial statements, and evaluating management teams to identify companies with strong fundamentals. One of the key principles behind Warren Buffett's strategy is the concept of margin of safety. This refers to the idea of buying companies at a price that is significantly lower than their intrinsic value. By doing so, investors can reduce their risk and increase their potential returns. For example, if a company has an intrinsic value of 100 per share, but its stock price is trading at 60 per share, there's a margin of safety of 40%. This means that even if the company experiences some difficulties, the investor has a cushion to fall back on. Another important concept in Warren Buffett's strategy is the idea of moat. A moat refers to a company's competitive advantage, its ability to maintain its market share and protect its profits over time. Companies with strong moats are more likely to succeed in the long term, as they have a sustainable competitive advantage that sets them apart from their competitors. For instance, companies like Coca-Cola and McDonald's have strong brand recognition and customer loyalty, which serves as a moat against competitors. Warren Buffett has also emphasized the importance of diversification in his investment strategy. By spreading investments across different industries and asset classes, investors can reduce their risk and increase their potential returns. This is because different assets often perform differently in various market conditions, so having a diversified portfolio can help smooth out returns over time. One notable example is his investment in Coca-Cola in the late 1980s. At the time, the company was facing significant challenges, including declining sales and increased competition from rival PepsiCo. However, Buffett saw an opportunity to buy into a high-quality company at a reasonable price and took a significant stake in the business. Over the next several decades, Coca-Cola's stock price soared, generating massive returns for Buffett and his investors. In fact, according to Berkshire Hathaway's annual reports, the company's investment in Coca-Cola has generated over $20 billion in profits since its initial purchase. Another example is Warren Buffett's investment in American Express. In 1964, the company was facing a major crisis due to the collapse of several large trading companies that had used American Express for their transactions. As a result, American Express's stock price plummeted, and many investors were left wondering if the company would survive. However, Buffett saw an opportunity to buy into a high-quality company at a distressed price and took a significant stake in the business. Over time, American Express rebounded and its stock price soared, generating massive returns for Buffett and his investors. So, how can you apply Warren Buffett's strategy to your own investments or business ventures? First, it's essential to develop a deep understanding of the companies you're investing in. This means doing thorough research, analyzing financial statements, and evaluating management teams. Second, it's crucial to have a long-term perspective, avoiding the temptation to invest in companies that don't meet your criteria. As Buffett once said, "Our favorite holding period is forever." By taking a long-term view, you can ride out market fluctuations and give your investments time to grow. Third, it's essential to focus on quality over quantity, looking for companies with strong fundamentals, competitive advantages, and talented management teams. This means avoiding companies with high levels of debt, weak financials, or unproven business models. Finally, it's worth noting that Warren Buffett's strategy is not just about investing, it's also about business leadership and management. By understanding the principles behind his investment strategy, entrepreneurs and business leaders can gain valuable insights into how to build strong, sustainable companies that create long-term value for shareholders. For instance, companies like Amazon and Microsoft have applied Warren Buffett's principles to their own businesses, focusing on building strong competitive advantages, investing in talented management teams, and delivering steady returns to shareholders. These companies have created enormous value for their shareholders over the years, and their success is a testament to the power of Warren Buffett's strategy. In conclusion, Warren Buffett's strategy is a powerful approach to investing and business leadership that has been refined over decades of experience and success. By focusing on quality over quantity, being disciplined and patient, and taking a long-term perspective, investors and entrepreneurs can achieve significant returns and build sustainable businesses. As we wrap up today's episode, I want to leave you with a quote from Warren Buffett himself: "Price is what you pay. Value is what you get." Remember, investing is not just about making money, it's about creating value for yourself and your stakeholders over the long term. Thanks for joining me on this journey into the world of Warren Buffett's strategy. If you have any questions or comments, please don't hesitate to reach out, like, share, and subscribe. And remember, every great business starts with action. Make your next move count.